So it's another great time we move to another topic of employee benefits. So this is the introduction to the topic. This is the introduction to the topic. So the employee benefits refers to all forms of considerations given by an entity in exchange of services rendered by the employee or for termination of employment. Remember that if your employment is terminated, if your contract is terminated, you're supposed to get a compensation. Remember, there's a mistake which is done there. In the word employment, this one is supposed to be employment. So the benefits, an employee gets. So terminologies to be used in the topic. We have a short-term benefits, like now salaries and wages, the one which accrue within a period of 12 months. Long-term employee benefits, benefits payable to employee after a period exceeding 12 months. It is a sabbatical leave allowance. Post-employment benefits refers to the benefits due to employee after completion of employment. Post, like pension. Termination benefits refers to the benefits payable to employee as a result of either an entity decision to terminate employment before the normal retirement or employment decision to accept an offer of benefits in exchange of termination of employment. So redundancy payments, early retirement. So we have what we call current service cost. So the current service cost refers to the benefits payable to employee after the pension scheme has been initiated. Benefits payable to employee after we do what? We initiate pension schemes. Past service costs. Benefits payable to an employee before initiation of a pension scheme. So for the current is after the pension scheme has been initiated, but for the past service cost is before the initiation of a pension scheme, before. First aid employee benefits, benefits payable to an employee after achieving a certain condition or without providing additional service to the company. That is it. Experience adjustments refers to the adjustments which are made to correct either experience surplus or experience deficit. So, Lilian,
mwenye alilipa
mute your mic.
Nilichukua namba yake.
You are on another call and you are here anyway. Experience supply. So experience adjustments, we adjust experience surplus or experience deficit. What about experience surplus? These are about when plan assets exceeds plan obligations. The plan assets, the assets of the pension schemes, their returns are exceeding the obligations. So to correct a surplus, the employees are normally required to take a contribution holiday, because even remember that pension schemes, they expect contributions to be made so on specific periods. So on some scenarios, when the pension schemes generates more than their obligations, what's supposed to be done is that the contributors are supposed to be told that you are given a contribution holiday. But I don't think if that one applies practically, it doesn't. So to correct the surplus, the employee is normally required to take a contribution holiday. A contribution holiday to stop contributing for a certain period of time. For the deficits, it's all about when the plan obligations, the liabilities exceed plan assets. So here now, to correct this deficit, the employees are required to do what? To make additional contributions. additional contributions are supposed to be made. So accounting for the overfunded and underfunded schemes. So how do we say that a scheme is overfunded? So a firm is overfunded in case where we have a surplus, where the plan assets exceed the obligations. That is when we say it's overfunded. So that surplus, when the assets of the pension schemes generate more than the obligations of the scheme, we say that we are overfunded. So there's a surplus. So we have said that when there's a surplus, the contributors to the pension schemes are supposed to be given contribution holiday. But this holiday, based on the surplus will be spread over the remaining service life of the employee. That is why they are saying that the surplus should be spread over the average remaining service life of the employee in the pension. So the amount to be charged in the income statement as pension cost is calculated as follows. So amount to P&L, amount to charge to P&L, you talk about normal contributions. So remember that the normal contributions the contributors are making now will be reduced by the surplus which arised because the assets generated more than what we expected. So the normal contributions will be reduced by the surplus. But this surplus must be done what? Spread over the remaining service life of the employee in the scheme. So assume the normal contribution is shillings 50 and the experience surplus by the actuary. Remember the guys who works in these pension schemes, some of them, they have done actuarial science. So they're saying that assume normal contribution is 50 and the experience surplus by the actuary is 200 million. The actual remaining service life of the employee is 10 years. So the amount to be charged in the income statement in each of the 10 years. So we have said, for us to know the amount to be charged, it's all about the normal contribution. You reduce the surplus, but surplus, you spread it. You spread it over the remaining service life of the employee. Like now here, this one is more direct. This is nothing I have to write on the whiteboard. This is something you can understand direct. So the amount to be charged to P&L, you take normal contributions. Then the surplus is spread over the remaining service life, which is 10 years. So amount to charge to P&L is 30. So underfunded schemes is whereby you find that employees required to contribute an additional amount because for underfunded schemes, the obligations are exceeding the plan assets. The obligations are more. So for us to clear the obligations, the contributors, that is employees, are required to contribute more than the normal contribution. So meaning that that deficit to be catered for, again, it has to be spread over the remaining service life of the employee, then meaning that we increase our normal contribution. We increase our normal contribution by the deficit, which is spread over the remaining service life of the employee. So you can see they were saying that a pension scheme could be underfunded in case a deficit arises. In this case, employees could be required to make additional contributions. So the amount to be charged in the income statement will be calculated as follows. You can see the normal contribution is increased with the deficit. We add. Remember the surplus was reducing. Yeah, deficit increases the normal contribution. But this deficit, remember, we spread it over the remaining service life of the employee. Like now, we have a small example. But we have not started major examples for this topic from the past papers. That is why I'm just explaining without writing on the whiteboard. When I would go to the past paper questions, that is when I will shift to my whiteboard. So they are saying that assume a normal contribution is 30 million with a deficit of 600 million. with the remaining service life of 60 years or 6, I think it's 6 years, 60 years, not 60. So because here we assume that normal contribution is 30, deficit is 600, remaining service life is 60 years. That is 60 years. This one. So meaning that normal contribution, you increase with the deficit, but you divide over the remaining service life. Normal contribution is 30. Deficit is 600, which you spread it over the 60 years. Then you add it to the normal contribution. That is how you find the amount to be charged to profit and loss. That is profit or loss. So this is an illustration for June 2006. This is sometimes back. You can never have this past paper. You will only use my question from these notes. And there's this illustration. There are two illustrations here. There are two. One is for a deficit, another one is for a surplus. Those are from 206. So once I'm done with this, that is when I will move now to the current past papers. That is, I will do a question for 2017. So let's start with this. It's not that wide. They are saying that ABC Limited contributes 30 million per annum to a pension scheme, and it treats the amount as current service costs. On 1st July 1998, the actuarial valuation of the scheme showed a deficit of 600 million. The actuary recommended that the deficit be cleared within 4 years by paying 150 per year, in addition to annual service cost. The average service life of the employee in the scheme on 1st July 1998 was 8 years, required for each of the remaining 8 years of the employee calculate pension liability or prepayment. Pension liability or prepayment. So you are told that the actual valuation of the scheme showed what? A deficit of, so let me make some short notes because you don't have that question so that you'll be able to understand what I will be doing. And so we are given ABC contributes 30 million. So that is normal contribution. That is normal contribution, the 30 million. On 1st July 1998, the actuarial valuation showed a deficit. So we have a deficit. We have a deficit of 600 million. The actuary recommended that the deficit be cleared within 4 years. Clear deficit within 4 years. Clear deficit within 4 years. By doing what? Paying 150. Pay 150. So they will be paying 150. In addition to annual service cost. The average service life of the employee is 8 years, service life. So we have 8 years. 8 years. So for each of the remaining 8 years, when they need what? Pension liability or prepayment. So what you do, you know that we said amount to charge to P&L when there's a deficit, you say normal contribution deficit you add over the remaining service right. So we know that the normal contribution is 30, the deficit 600 divided by 8. So the amount to charge to P&L is so 600 divided by 8 plus 30.
105.
So we have 105. But what the examiner was in need of is all about, we show what? The pension, calculate pension liability or a prepayment. Pension liability or a prepayment. So what you do, you talk about the year, that is the year, the contributions, you talk about the contributions, you talk about annual expense. Annual expense, then you talk about the prepayments. Or the liability which they need. So here we have 8 years. 1, 2, 3, 4, 5, 6, 7, 8. Remember, for the contributions, they said there was a deficit of 600, which we need to clear within 4 years. By contributing 150 plus the normal contributions. So meaning that for the first 4 years, there will be the normal contribution plus the 150, which will be clearing this deficit. Meaning that for the first 4 years, I will be talking about a contribution which is supposed to be made of 180. And now for the other years, remember that it started at. So annual expense, that is amount to charge to P&L, is this 105. The amount they were charged. Amount they are being charged in every year is 105. So now, how do you know that there's a prepayment or a liability? So now you compare the two. You compare the two. Which two am I talking about? You compare the contribution and what they are charged, amounts to be charged. So here they are charged 105, they contributed more. The contribution is more than what they are charged. So meaning that there's a prepayment. 180 minus 105?
75.
75.
Yes.
Even here there's a prepayment because they contributed more than what they are being charged, the annual expense, by 75. But now this one must be cumulative, plus the previous one. So this is 150. 75 of this year plus the previous one. So plus another 75. 150 plus another 75. 225. Another prepayment of 75. So this one would be 300. But now from here going down, there's a liability. Like now here they were being charged 105. They contributed that. So there's a liability of
75.
75. There's a liability of 75 going down, each 75. But remember already they had prepaid a total of
300.
So we'll reduce these prepayments by 75, 75 to cancel the liability. So 300 minus 75, the liability 225, 150, 75, 0. That is how you compute the prepayment or liability. We do the next illustration. So the next illustration here, they are saying that XYZ Limited contributes shillings 60 million to a pension scheme. On 1st January 1996, the actuarial valuation showed that the scheme had a surplus of 320. So the normal contribution, so I can be making again the short notes. The normal contribution, according to that question, the normal contribution is 60. Normal contribution 60. Normal contribution 60. There's a surplus of
320.
320. The actually recommended non-contribution. You know that we said when there's a surplus, they are supposed to be given a contribution holiday. They don't contribute anything for a certain period of time because there's a surplus. The actuary recommended non-contribution to the scheme for 3 years. Contribution holiday. Contribution holiday, 3 years. They don't contribute anything. Then the resumption to a contribution of 40. So then they will contribute 40, contribute 40, contribution of 40. For how many years?
7 years.
7 years, huh? 7 years before reverting to the standard annual contribution of 60. The average remaining service life was 10 years. 10 years remaining service life. So they need also, we calculate pension expense or liability. So what you do here again, you say amount to be charged to P&L. So remember the normal contribution. Remember for the surplus, you minus it. It will reduce the normal contribution, but spread the surplus over the remaining life, remaining service life. So normal contribution 600 or 60. Surplus 320 divided by 10. 10 years remaining service life. So this is all about 60 minus 32. 28. So here, so we have 10 years, 9, 10. So annual expense will be obvious 28. One, 2, 3, 4, 5, 6, 7, 8, 9, 10. So contributions, they said that they would be given a contribution holiday of 3 years, meaning that 0, 0, 0, nothing to be contributed. Then they contribute 40 for the next 7 years. 1, 2, 3, 4, 5, 6, 7. So if there was the 11th year, that is when they could have reverted to the 60. but we have only 10 remaining service. See, life, that is the years are 10. The service life is 10. So how do you know there's a prepayment or liability? You compare the annual expense and what they contributed. Like now here, they contributed nothing. The annual expense is 28. So meaning that there's a negative of 28, a liability. So here they were being charged 28, they contributed nothing. So this is 28 again. So plus a liability of 28 from initial, 56.
6.
Then plus another 28.
84.
8. But now from here going down, there's a, because they are charged this, they are contributing this. There's a prepayment of 12. There's a prepayment of 12. But already we have a liability of 84. So this liability must be reduced by, not the liability must be reduced. The prepayments from the 4th year to the 10th year, the prepayments will reduce this liability. So 84 minus 12, 72.
72.
But that is a liability again, minus another 12, 60.
60.
Minus another 12, 48.
48.
Minus another 12, 36. Minus another 12, 24. 12,
12.
0.
0.
So after this, we talk a bit about the pension schemes. So post-employment benefits. So this is now the major area for this topic. Post-employment benefits. An example of a post-employment benefit is pension. So it refers to the benefits due to an employee after completion of employment. That is why I'm using an example of a pension. You get pension after completion of an employment period in your area of employment. So the employee is required to contribute to a pension scheme in order to be entitled to a post-employment benefit. Like now, see, you are deducted the NSSF. Types of pension scheme: defined contribution, defined benefits plan. So when we talk about defined contribution, you can explain the defined contribution from the word contribution. You always say that the contributions made are fixed. But now the benefits fluctuates depending on plan assets. So when you are talking about defined contribution, you see that the contributions are fixed, but the amount to be received as a benefit fluctuates. When you are talking about defined benefits, the benefits to be received is fixed in advance. The benefits to be received again is fixed in advance. So from the word benefit, so the benefits are fixed. But the contribution now fluctuates depending with the employee. So how do we account for defined benefit? That is what the questions now will be driven from. We will drive questions from the defined benefits, because now defined benefits is what the employee would be getting from the pension scheme. That is what the pension scheme needs to account for. So the benefits employee is supposed to receive is always fixed in advance. However, the contributions fluctuate. So how do you account for that? There's a method known as protected unit credit method, which is used. So under this method, the expected surplus or deficits in the employee obligation to a defined benefits, pension is reassessed. So we reassess. So upon reassessment of the scheme, they may arise actuarial gain or loss. So the actuarial gain should be reported in the income statement as part of other comprehensive incomes. So to determine the net actuarial gain or loss, to report in the income statement, the actuarial gain or loss on plan assets should be netted over against the actuarial gain or loss on plan obligations. So these are the steps you need to know. So we always start by determining the actuarial gain or loss on plan assets. Then next, actuarial gain or loss on plan obligations. Then the loss or gain we get from the two steps, we net. Then you might be asked to do an extract of the income statement and a statement of financial position. So for you to determine a gain or loss on plan assets, you will start with the fair value of plan assets. You add expected rate of return. Annual contributions is added, you rest benefits paid. You get actuary's expected value. So this is the answer you get here. Once you compute this, then fair value of the plan asset at the end will be given. So you have computed this, then this is given. So what you need to determine is this, gain or loss. Gain or loss. So I will show you on how to determine that based on the analysis which is done between the two. Because I can mention anyway, because the fair value of the plan asset at the end, this is the actual outcome, and this is what we expect. So meaning that if I say A and I give this B, so if the actual outcome, remember this plan asset, if the actual outcome is more than what we expect, that one would be a gain. If this one would be more, if B will be more than A, that is our gain. If B will be less than A, that's our loss. That is our loss. And after doing the first step, you move to the next step for the obligations. Present value of plan obligations, interest charged, current service cost, past service cost, and benefits paid you deduct. So again, you get this. Also, this one would be given, which is actual outcome, present value of plan obligation, balance carried down. So now what you need to determine is gain or loss. So remember, this is an obligation. So let me say this is A, this is B. So if B is more than what you expected, because this is the actual outcome. If the obligation B, which is an actual outcome, is more than what you have computed, that is a loss. Because the actual outcome is more. The obligation at the end is more than what you expected. So that one is a loss. And if the actual outcome is less than what you have computed, that is a gain. And now the answers you get from the first step and the next step, from the plan asset and the plan obligations, you net them. You net them off. So up to that point, after you have understood that, these are past paper questions I will do, but not today. But I can show you how the obvious test these, how the obvious test and these are questions. How the obvious test these questions. I was having them. Where are they? Where are they? So there we go. Just a minute, just a minute, just a minute.
2017 2C.
Yeah, so this one here. Already you can see we have done question 2. B, 6 marks. So C is employee benefits. Again, 8 marks. So the information was extracted from the books of Comfort Retirement Pension Scheme for the year ended 31st October 2016 and 31st October 2017. Discount rate, expected rate of return, average service life, fair value of plan obligation, present value of plan obligation, current service cost, benefits paid, contribution to the scheme, past service cost. Additional information, as at 1st November 2015, the present value of plan obligations and the fair value of plan assets were both 100. Assume all the transactions occurred at the year end. For each of the years, 2016, 2017, they need actual gain or loss, net pension costs, balances to be reflected in the statement of so the second one is all about net pension cost to be charged in the income statement, and the balances to be reflected in the statement of financial position. Time will not allow, but if you follow the 3 steps, you can be able to do that question and give us the first answer, the actual gain or loss. The only thing which might be difficult on your end is to do the income statement and statement of financial position. But what appears in the income statement? Just incomes and expenses. Incomes and expenses. So which incomes do we have here? Expected return. Expected return. Expected return. Expenses is current service cost, past service cost, either actual gain or loss from the step 3. What appears in the statement of financial position? The plan assets and the plan obligations as at the end of the year. That's all. So guys, we meet tomorrow because time cannot allow we do the question. We meet tomorrow, we do it. And we do one more for 2012. Then I talk a bit about, there's an aspect of corridor limit, which says that we are not supposed to recognize the full actual gain or loss in the income statement because it brings a larger variation. That is where the corridor limit comes in to tell us which is the actual gain or loss to be recognized in the income statement. But they have never tested the concept of corridor limit currently. I've never seen a question of that kind, but I will be able to do it. Then I would say that you are okay with that topic. That is the work of tomorrow, doing 2 extra questions and talking about the part of corridor limit. And I think after this topic, I will see if there's another small topic remaining before I introduce next week another major topic, that is earnings per share. Then we move to reconstruction, we come back to group accounting. Then finally, I will be able to do general checkup on what would be remaining. And that is the work from today, I think, until the end of March. But by the end of March, we are supposed to have finished the syllabus so that maybe we do block revision the start of April, and you will be prepared to sit for your exam. So have a good night. If there's any question, yes.
I'm asking, could you kindly share the notes for this last topic that we've been working on?
Sorry?
Could you kindly share the notes for there was this notes that we've been using, the latest one.
Oh, so
And
okay, I will share that document to your group. But they are just the same as they are just the same as the others, but I will share it. Let me even share before I end this session. Any concern as I share? Mko sawa? Mumejipanga sawa sawa? Mm. Sawa sawa, that's all for tonight. Haya. I have shared to the group. It's coming, so it will take time because it's a bit heavy. You will receive it on your end. Good night. Good night. Let me end the session.
Good night.
All right, bye.
Okay.